All right, we are at our time here, so I'm going to get started. So hopefully everybody can hear me. If you can, maybe send a ping my way, but want to honor your time and thanks for being on time. So I'd like to start things off by not only welcoming you here, thank you for being here, but I also like to congratulate you for being here. I often say that at presentations like this because we all have busy lives, and the fact that you're here today to learn about retirement planning says a lot about you. And retirement does take a lot of planning, especially in today's day. I like to talk about, coming off of 2022, we had a pretty tough year. The S&P 500, the 500 largest publicly traded companies in the US, was down 19%, give or take right around there. The NASDAQ, which is a basket of about 4,000 companies from large to small, publicly traded in the US, so a good representation of all US companies, was down over 33%. We haven't seen these types of down numbers since the Great Recession in 08 or the dot-com bubble in 01. So that's 15 to 20 years roughly. So those are big numbers. Then actually one of the craziest parts was the bond market. It's called the Barclays aggregate bond market. That was down 13%. And this was the most that this index has ever been down in the history of this index, which goes back about 50 years. That was down 13% last year. It's even tough to look at when the next closest was like 2%. So this was its biggest drop. And so I like to relate that to a 60-40 portfolio. This is more, closer to us on this webinar, like an individual investor. If you had 60% S&P 500 and 40% in the bond market, you were down 16%. That's a pretty big number to be down, considering this 60-40 portfolio is in general considered like a moderate risk portfolio. Some would even argue that it's kind of a moderate to conservative portfolio. So to be down 16%, then it's, somebody that was near retirement last year or this year going to retire, they're asking themselves, hey, did the rug just get pulled out on me for retirement? Can I still retire? Or maybe you have to retire. Maybe you've submitted your paperwork to your company, so you have to retire. But now you're asking yourself, do I have to get a part-time job? Or can I just not do the things that I might want to do in retirement, like travel, play golf, see the grandkids and kids? So it has been a crazy time. And so that's why I did this webinar. This webinar is specifically and custom built by me. That's what I was trying to say, custom built by me. This isn't an out of the box or product specific. This is questions that I'm getting from clients looking to retire now, and just things that I do in my practice in the real world. So we're going to talk about some strategies that you can, with a little bit of planning, retire in any market conditions. So I do see a lot of names on here, familiar names, so good to see you. But then a lot of new names as well, so welcome. And so for those of you that don't know me too much, but maybe follow me on email or social media, a little bit more about me. Again, Ryan Hitchcock. I'm a financial planner and partner at our firm called the High Point Capital Group. Now, High Point Capital Group is an independent fiduciary financial planning and wealth management practice. I know I always say that's a mouthful, and we can unpack that down the road. But in general, we have just over 20 advisors that work with individuals and families for investments and general financial planning. Our main office is in Milwaukee, Wisconsin. We have some offices around the state and Northern Illinois, but I myself work a lot virtually with clients all across the country. And mainly what I do is work with that kind of mid-career to retirement age individuals and families, trying to get them to and through retirement. Now, I'm not going to go into this too much. Most people have heard of this word, but always when you're looking at advisors, make sure that they're a fiduciary. I have some videos on what a fiduciary is in my Facebook or YouTube, but it's a very important buzzword that not all advisors are. So as I mentioned, all of my webinars like this, not most, all of my webinars like this are meant to be just educational. There's not going to be any product specific recommendations or investment recommendations. This is all comprehensive financial planning information. So my goal is for you to take it as you will, use it on your own, use it with your other advisors in your corner. But you do have the chance. I'd like to give this opportunity. If you want to take me up on an offer, I will sign up for a meeting with me and I will build you a personalized financial plan. I use software, some of the best financial planning software on the street called eMoney. And we'll run through some scenarios. This is some example of, some good charts and graphs and recommendations on your retirement. And there's never going to be any hard sell or expectation that you have to do work with me, but it's an opportunity to get some more advice on your financial planning. So I put this right up front because I know webinars, sometimes people jump off here and there. So you can sign up at my website to do a meeting. Go to rhitch.com. There's a big box on the top right that says work with me, and you can schedule a time automatically in there. This calendar links to my calendar. So if you have any questions, feel free to email me as well. But we're going to get right into it. We have a lot of info. I want to just kind of pound a lot of info in here in about 30 minutes and get in and out here. And the three things we're going to cover today is, one, what are these three biggest risks of retiring in any market condition? Then we're going to talk about ways to build a solid income plan to last your lifetime, last your retirement, kind of ways to mitigate these risks. And then we're also going to talk about some tax hiccups that just kind of go hand in hand while building these retirement plans. So the three biggest risks to retiring in any market, in my opinion, are market timing. How is the market performing as you're getting close to retirement? As I just said at the beginning of this presentation, we're coming off some crazy years. Is that going to continue? Is it going to go up from here? Are we going to be in another lost decade? This is something people forget about. I got terrible handwriting, but from 2009 to 2009, look it up. Market didn't do much during these times. So how does the market, do during close to your retirement, which we'll get into? How does inflation handle your retirement? We're in in the last 40 years, this is the biggest inflationary period we've ever been in. And how does that affect your retirement? And then the big variable in any retirement is healthcare costs. So how do you kind of mix these all together? So looking at market timing, one of my favorite concepts is called the sequence of returns. It's kind of a crazy, stupid name for us financial planning worlds. And I kind of geek out on this term. It's kind of an interesting way math works, but it's a good example to show how the market, what the market can do to your portfolio as you're getting near and at retirement. So I'm going to demonstrate this in two slides. And the first slide here is first going to show what the sequence of returns, what, the market does over time while you're just building a portfolio. So we're not taking money out, we're building it. And so what we're doing is we're comparing two portfolios, portfolio one and portfolio two. Each of them start out with $500,000. Portfolio one follows the S&P 500 for 26 years over this time frame of 1969 to 1994. And I'll go into why I picked those years. But portfolio two is the same thing, 26-year period, but it's just doing those returns of the S&P 500 in reverse. So if I kind of go over here, what you see is the first year, the market lost 8.42%. Then it went up 3.98 and then up 14% from there. And then portfolio two is just the opposite. So if you see those numbers here, those just go in reverse. And what you can see is at the end of this period, both portfolios end up with the same dollar amount, 6.1 million. So what it's telling us is that it doesn't matter the sequence of returns, when the returns happened, whether they were, big years, big up years in the beginning or big down years later, or vice versa. It doesn't matter. There's still a 10.1% average rate of return for the lifetime of this portfolio, and you ended up with 6.12 million. Now, if we jump to kind of what's called the distribution phase, like you went from accumulating your nest egg, now you retire. Now we're starting to take money off of our nest egg. So that's called the distribution phase. So it's the same scenario, still starting with a $500,000 portfolio, comparing portfolio one and two. The only difference is we're taking $30,000 in income off of these portfolios that increases by 3% with inflation every year. And watch what happens to these two portfolios. So if we look at portfolio one over this 26-year time frame, you end up with only 19 grand, just over. Whereas portfolio two, at the end of this period, you end up with 2.5 million. The only difference between these two, and this is why I picked these years from 1969 to 1994, is that in the first 10 years of this scenario's retirement, there's 4 down markets. And so if I kind of draw this line here, first year, 5th year, 6th year, 9th year, there were some down markets, one big one in there, or 2 you could call it. And simply, well, let me explain this a little more. Later, there's all kind of up years. There's very few, only 2 down years later in this person's retirement. So what this demonstrates is that if you have down markets right out of the gate of retirement while taking money out of your portfolio, can drastically reduce your chances that nest egg can last a long time. Compared to if there's up years earlier in retirement and then lots of down years later in retirement, it doesn't matter. That portfolio still had enough time to kind of sit and cook and compound to still have a good amount of money left down the road. So long story short, this concept is the number one risk. This is what we're seeing in the market come last year. And so I think it's an easy risk to diversify against from just certain investments and investment types and all of that if you do a little bit of planning before retirement. And we're going to talk about that, but it is the number one risk that I see in any market. Risk number 2 is inflation. So we've all seen inflation now. Is, like I said, the biggest inflation we've seen in the last 40 years. So pretty much anybody that's kind of in this boat of mid-career to retirement age, this is the first time you've really experienced high inflation. And so again, inflation is just at its base, the rising cost of goods and services over time. And so essentially $1 today will buy more than it will tomorrow or a year from now or 10 years from now. And what that's called is just the loss of purchasing power. And so in general, in retirement planning, you want your nest egg, your retirement assets to at least keep up with inflation so that you have that same purchasing power. So I like to show this example by simply a 3% inflation over time. So if somebody that's 65 years old, retiring and needs $70,000 of income, at 3% inflation in 10 years, they're going to need 94 grand to keep that same purchasing power that they did 10 years ago. In 20 years, at age 85, that's almost doubled to just under 130,000. And then in 30 years, it's up over 170,000. So inflation is real and does have an effect on retirement, even at a smaller number. Now, when I do retirement planning with clients or potential clients, I like to make sure that they understand what their personal inflation rate is. Even more so, this is very important now. So what I mean by that is, we all kind of have gotten lost. I'm guessing, everybody hears this on the news. The CPI, the government comes out with this CPI number. It's been, 6.5, 7, 8, 9%. Those are all like headline numbers. But I encourage people to really dig down and kind of figure out what their personal inflation rate is, especially in retirement. What I mean by this is, think of like somebody that likes to stay at home in retirement. Maybe they like to cook at home. They're not really a big traveler compared to this person that likes to maybe drive across country. And so for this traveler, the cost of gasoline is obviously going to be more important to them than the person that stays at home. However, the price of, foods at home, like eggs right now are crazy expensive. They might be, more important for this person than this person. A sporty person might care more about the cost of goods and services and apparel, or medical. Obviously, that's going to be a very important one if you have some medical issues. Now, how to do this? I'm going to kind of jump a screen here and give you some of my secret sauce. There is a great website that the government has from the Bureau of Labor Statistics that you can really drill down into this information. Email me, sign up to talk to me more later, and I can kind of walk you through this exercise. But just to give you a high level view, this is the December CPI report that came out, and it shows you all major categories came out at 6.5%. Food was high at 10%, energy. But if you kind of click through this, just show a table, you can pick out specific things that might be of importance to you. So I'm really encouraging people to really look at this and kind of, I have some stuff built out that you can build into here, but, specifically, let's look at, there's food at home is broken out differently than food away from home. Energy, new vehicles, shelter, alcoholic beverages. These things get broken out really nice. And some other cool things you can drill down in this website is you can look at by where you live. So you can click around and say, hey, I live in the Midwest. How do we compare to the Northeast? And unfortunately, Midwest has actually been a little bit higher inflationary period than the coast have throughout this time. So it's just an interesting way to really kind of drill down into, understanding what your personal inflation rate is. So going to keep on going here. So the third risk is healthcare. In any retirement planning, any market conditioning, healthcare should be pretty much, number one thing as well. It's kind of after your market goes hand in hand with retirement planning. So this is a report done by a financial institution called HVS Financial. They do some great retirement healthcare cost reports. And so what they said in 2001, this is going to be going up in the next couple of years, but this is their most recent report. This is the average price that a 65-year-old couple retiring is going to pay on all of their healthcare expenses. So that's on their Medicare supplements, and dental and vision. And that's just the average. What it's showing is that in inflation, as we just talked about, healthcare usually rises at a larger rate of about 2 to 2.5 times that of the normal inflation. An interesting stat is that people that retire, so this average 65-year-old couple that retires is going to spend 68% of their Social Security just on healthcare. However, this is just the average. This bogey can range from, a couple $100,000 all the way to a couple million. So there's a lot of unknown variables that you have to figure out in any market of your healthcare. Things like, where do you live? What kind of coverage are you going to get? Do you have certain medical situations that you need to really address? And then, that's going to affect your total cost of healthcare. And so I like to explain this because this is maybe different than people think by just showing you some examples. So if I show you, this is Joe and Jane, they're a 65-year-old couple. They have an income of $150,000 in retirement, which is important because that comes into play with how much your Medicare is, which I'm going to talk about. But they have some medical issues. So let's just say that one of them has some diabetes and one of them has some high cholesterol. So that means that their life expectancy is 85 and 81. Their lifetime healthcare cost is going to be right around $500,000. So it's actually a little less than the average, maybe opposite than what people think. So let's look at a different couple. Same situation, Fran and Frank, they're age 65, same income. However, they're healthy. They don't have any chronic medical conditions, but they have a longer life expectancy. So a longer life expectancy means they just have more time to pay medical expenses. And with medical expenses, healthcare costs rising at usually a higher clip than normal inflation, it's going to bring their total lifetime cost of healthcare up to $662,000. And then my last example here, Sam and Sarah, they just make a little bit more income in retirement, but that means some of their other costs like Medicare Part B is going to be more expensive, but they're still healthy and they have even a longer longer life expectancy of 89 and 91. That pushes their lifetime cost of healthcare up just about to $1 million. So again, this is sometimes interesting to people because a lot of times people think if they have more medical costs, it's going to be more expensive than retirement. Whereas the people that do not have, chronic medical situation aren't just going to skirt by with less medical costs. Okay, so we talked about the 3 risks of retiring in any market timing, big one now today. We talked about inflation and healthcare costs. So now let's talk about how we can kind of mitigate those risks and build an income plan to last, your full retirement. And it's pretty simplified here. This isn't, mind-bending stuff, but you first have to figure out what type of person you are in retirement. Figure out your goals, such as where are you going to live? What are you going to do? Like I explained a little bit in, your personal inflation rate. That's really going to be your starting point, because then you can start to figure out how much that costs. What is that total cost of what you want to do going to be? And then you figure out how much or where your income is going to come to cover those expenses. And then the last thing here, you got to make sure you cover for unexpected expenses. But I'm going to dive deeper into this in the next slide, where your needs should be covered by your dependable income, and your retirement wants should be covered by more of a discretionary income. So I'm going to kind of focus on that section right here. So again, this isn't mind-bending stuff, but it's just some simple ways to help kind of identify and kind of organize, I call, your expenses, and figure out how you're going to pay for those expenses, kind of earmark income and assets for certain expenses. So things like, your food, heat, shelter, light, healthcare, this is going to be specific to each individual, but most people agree those are the needs that you have to have covered. Just to live in retirement. And so, in my opinion, that should be coming from a predictable income source. Predictable income sources are things like Social Security, pension, or maybe some other types of annuity payments that are not affected by the market. So these are things that, no matter what's going on in the market, like we did last year, you're going to be able to sleep safe at night, or feel comfortable at night, I should say, and know that the income coming in the door monthly is not going to be affected by that market. Whereas maybe your, discretionary fund stuff to cover, travel, hobbies, whatever it may be that you like to do, can come from more of a discretionary type of stocks, bonds, mutual funds, but you just have to structure that type of assets correctly. So let's jump into just income sources a little bit deeper. So in my next slide, I like to talk about, this is pretty, people always come and ask me like, okay, how do I actually take income off of my assets? How do you figure that out? And that's what we're talking about here. There's really two ways that you can take income in retirement off your assets. The most common one is just called a systematic withdrawal. Again, us financial planners, we don't have smart names. It's just, we're calling it what it is. And a systematic withdrawal is simply taking a certain amount of money at a timely fashion, so call it monthly, off of your nest egg to create an income source for you in retirement. And so some pros and cons kind of go along with that. And so how long that lasts, if I draw a kind of a statement here, let me kind of, I like to draw, like if it's a statement, your bucket of money, your nest egg, you have a bunch of holdings in here. Essentially, this is your bucket of money, and you're turning on a spigot to this bucket that's just going to pay you income. Going to pay you monthly. Now, how long that lasts is just going to depend on how much you're taking and how big your bucket of money is. Now, the good thing about this type of strategy is it can manage inflation well, because simply all you have to do to keep your purchasing power is maybe take more money per month. Now, that might lead you to overspending, and maybe depending on how it's invested, leads to some timing risk like we talked about earlier. And so that could deplete that nest egg quicker than you expected. But that's just part of that flexibility. But the other good thing about this type of systematic withdrawals for income is just it's complete open architecture. So if there is unexpected events that you need more money, think of your bucket has no lid on it. So you can take as much money out as you want to cover those needs or expenses. The opposite end, or the other side of the coin of creating income in retirement, is what's called annuitization. So again, bad name, but it's simply what annuitization is things like Social Security or pension. We're all familiar with those things. Now, I like to explain it that there's still a bucket of money with your name on it somewhere behind the scenes or curtain that somebody has, whether it's the government or the pension department. However, all that you get is this dependable income stream. So instead of having access to that bucket of money, you're getting this monthly income, yearly income at whatever clip you have. Now, the good thing about this type of way, obviously, is that it's going to last your lifetime. Okay, there's no risk that it's not going to be there. depending on, the pains claimability of my little disclaimer down there. If it is like an annuity or some sort, or a pension, there is some risk there. But essentially, it's going to last your lifetime. But once you have these set in place, usually you can't get more money. You can't go back to the pension department in most cases and say, hey, I'm getting $500 a month. Now I want $600 a month. That's not how it works. So it can't really protect you against inflation. There's no overspending or timing in the market risk, because essentially it's not in the market and is not, it doesn't have anything in there. However, you can't dip into this bucket because it's like this kind of lid on the bucket is closed. So you can't dive in there for more money. All you can do is get the income stream. So I like to think of it this way, kind of going back to this slide. There are hybrid types of investments out there. So thinking of that annuitization, where some people should look into this. These are a bunch of different good and bad types of annuities out there. These are some like hybrid annuities where, remember how I said you still, where you can't have access to this bucket of money, where these new ones can give you some access to that money, but still give you some guaranteed streams of income. There are some red tapes to that and all of that. So talk to me about that. But it is a way to kind of have your cake and eat it too. And simply by bucketing, I like this bucket approach by building buckets of money for kind of short-term, mid-term, and long-term is a way to, invest your money well too. So if you're doing systematic withdrawals by having a short-term bucket of money that is pretty conservative, it's a good approach. That takes the current market risk out, and then an intermediate bucket. So that's, 10 years out, maybe 7 to 10 years out, where it can invest a little bit more aggressively. Or moderately, and then a bucket of money that is more long-term, that is more of your aggressive investments that can keep up and withstand some down markets. Those are some high-level ways that you can put this all together using income and kind of systematic withdrawals and annuitization, I should have said. So talking about income, I like to throw in Social Security because most people or everybody asks me in retirement planning, when is the good time to take Social Security? And I am a little different than most people, as Social Security can be taken for any time between age 62 and 70. And anybody that talks to their neighbor, they'll say, well, you should always wait and take your Social Security at age 70 because you're going to get an 8% increase each year, which is true. And if you run any calculations online, they're always going to say by taking it at age 70, you're going to maximize your Social Security spending, which is true. However, I think Social Security is more of what I call this philosophical question, and it's more individualized depending on what's going on in your life. Things like how your health is and what your longevity outlook is, depending on your family history, might be a big factor. If you have short longevity, then you probably want to look at taking Social Security early. The crossover point from taking it at age 62 to taking it at age 70 is somewhere around your late 70s to early 80s. So that question becomes, do you want more of your Social Security income earlier in your retirement versus later, and maybe, when you might not be here, God forbid. You also have to look at what other income you have coming in the household, and does your spouse have Social Security? How do you manage 2 Social Securities in a household? I'm going to be doing a Social Security specific webinar coming up, so I'm going to dive deeper into this stuff, but this is just some high level things to think about. The other thing is, will you keep working? So let's say you want to turn on Social Security at age 62, but want to keep working till 65. There are some things you want to know about there. For example, the government says if you are under your full retirement age, you can't make more than $21,000. Well, you can, but they're going to start peeling away $1 for every $2 that you earn above that limit. It's only until you reach your full retirement age that you can, that's in the first year, but after your full retirement age, you can pretty much earn as much as you want. So there's some, kind of planning that needs to go into Social Security and your, full retirement age, and if you're working or not. So just a little whet your appetite thing right there. So getting into our third category here, and we're plugging along. some tax hiccups. So we've talked about risks of retirement in any market. We've talked about how to kind of build a income plan in retirement to try to hedge against those risks. But some tax hiccups that come up that I commonly see, I just wanted to put in here. A lot of times I'll see this situation happen. What I call the RMD cliff. And so RMDs are your required minimum distributions that you have to start taking out of your IRAs and 401ks at age 73 now. This is just a new law this year. It used to be age 70 and a half, then it went up to 72. Now it's going to 73 this year, and actually is going to go up to 74 in the coming years as well. But in this example, somebody that might run into an RMD cliff is they might be a husband and wife. They've been great savers. They put all of their money, though, in either IRAs and 401ks, and then they get to retirement. They might have pensions, Social Security, so they really don't need a bunch of money off their investments, which is a good problem to have, but they could run into this RMD cliff. So let me kind of explain it that way. So let's just say that's a husband and wife is making 155 grand in retirement. So pretty good income. They have, Social Security, they have some pensions, and then maybe they're taking some money off their IRAs or 401k. But maybe on the side here, they have, let's call it $1 million sitting inside of an IRA that they really don't want to touch. That's just going to sit and cook in an investment account, and they're going to pass it on to their kids and grandkids. Very noble of them. But let's say they turn age 73, and then the government is going to come knocking and say, this money is IRA money as well. And so we need you to start taking an RMD, which at age 73, this required minimum distribution is right around 3.8%. So now I'm just going to round, you have to take another 40 grand of income that maybe you don't need, but now you're having to pay taxes on. So now you have a $195,000 income for that year. Okay, Ryan, great. It's just more income. However, more income sometimes can be more problems. The other tax situation that come into play is it could affect your Medicare premiums. And so this, a lot of people aren't familiar with this, but your Medicare Part B is bracketed by your income. So depending on how much income you make in retirement, was going to tell you how much you have to pay for your Part B in or Part A, excuse me, whichever one it is, that comes directly off of your Social Security. Everybody that is in under $194,000 in 2023 is going to pay $164.90. But in my example, where people can get in trouble is if you're $1 over that. So you're now, in my example, in this bracket 2, because we're at 195,000, your Social Security, IRMA, this part, Social Security that comes off of this Medicare, that comes off your Social Security is now going to be $230. That's a 40% increase that you have to pay that full year until you can prove the next year that your income is below that amount. So everything is connected is my point here. It can be planned away from just, things like this might entail Roth conversions earlier in retirement or before age 73, things like that. So, or maybe spending down your IRAs sooner than you might have thought you should have. So there are some planning strategies to go through that. So that's all I have today. We went through a lot there quickly. So you might be thinking, okay, great. This is great info, but how can I use this for myself? So like I said, I saw a lot of, people that I've been working with. But for those of you that don't work with me, I want to give you the opportunity to say, hey, I can take this information. I can do it on my own. This is all comprehensive financial education. It's not any recommendations or product specific. Take it to your other advisors. That's totally fine. I'm meant to be a resource here. If you do want to work with me, I'll give you that opportunity. But don't procrastinate. Procrastinating in retirement planning is where a lot of these issues can come in. All of these risks that I've mentioned today can be planned away from with just a little bit of time. So as I mentioned, for being on this webinar, I'm going to give you a complimentary financial plan using my eMoney software. It's usually $1,000 that I charge people just to do this because it does take a lot of intake, the data intake and running some scenarios on the software. And as I showed, this is some examples of the report, but how it really looks, what I call putting it together, it's usually just 2 meetings. There's no heavy push for me to say you have to do business with me. There's no obligation. It's simply going to be a 2-meeting type of thing. The first meeting, we're just going to kind of go through what's going on in your situation, explore goals, figure out what you want to do in retirement. I'll go back to my office, do some homework, and then I'll set up another meeting with you and do and deliver you this financial plan, whether that's virtual, in person, whatever works best for you. And at the end of that, you can take that plan and do what you will with it. Or if you want to continue to work with me further, that'll be completely up to you. Again, you can go to my website at rhitch.com. There's a box on the top right of the main page, or that's going to say work with me. And then down below, there's a self-scheduler that you can click intro call, match it up with your calendar and throw a time in there, and you can pick either virtual, in person, whatever works for you. My goal, again, I'm trying to take the confusion out of these topics. I've tried to show you that, don't just use your neighbor's advice. You really need to have specific personalized retirement plans. And a lot of people get stressed out about this, especially coming out of last year. It's been a stressful time. So, use the resources you have, use me, use your other advisors so that you can feel confident and get a solid retirement plan in place. I like to say, stop using Google. Stop using what you heard from your neighbor and stop thinking you need to be an expert. There's a lot of moving parts in retirement planning. As I mentioned, tax, healthcare, investments, cash flow planning, it all needs to work together. So you don't need to be an expert in all of that. Inside my meetings, I usually cover all of these things as well. We're usually talking about, investments, retirement forecasting, budgets. We'll look at your 401ks, do a Social Security analysis, check up on some debt and beneficiaries. If we need to get some legal docs for tax planning, I can help make those recommendations as well. Again, this is all complimentary in the first 2 meetings. Now, if you don't want all of that and you just have a couple questions, still sign up. Before we commit to any of that, we'll see if it's a good fit. We don't need to go through that full process. If you don't want to, we can take 15 minutes and see if I can be a help with you. If I can answer any questions, great. That's my job, to be a resource. If I'm not a good fit, I'll try to refer you out to somebody who I think might be. So take me up on that offer. So that's all I have today. Thank you very much for joining. I was pretty close to my timing here. Again, I'm Ryan Hitchcock, and if you have any thoughts or comments, please let me know. These are my disclosures through SagePoint. Again, this is not meant to be any recommendations. This is just all illustrative purposes. Please consult with me or your other financial advisors for your own personal financial situation. So I'm going to leave it at that, and thank you guys very much for joining here, and I hope you have a great rest of the day.